Alex and Eric, Crowdfunding, thank you guys for having us. We appreciate it. So I'm Kevin Shane. I'm the Director of Community Development at Share Estates, and we're a real estate crowdfunding platform. So a little bit of a quick background of how I got involved in this space. I actually worked at Lending Club back in 2009, 2010. Left that space for a while, really wanted to get back into it. And I was looking at what the next emerging trend would be in the marketplace lending, and real estate kind of came up, and obviously it's been blowing up. So I ended up reaching out to Alan a few months back, or maybe like 6 months ago, and he kind of convinced me that real estate was definitely the next big trend. I really liked meeting with Alan, his team, and maybe a month later I actually joined the team. So that's a little bit about me. I've been just doing, on the community development side, it's really just outreach, making sure that there's a marketing side of our platform and some sales going on too. And I'll let Alan just give a quick bio and then get back into it. I'm going to basically fire some questions at him. And then, like Alex said, we're going to open up some questions to the audience. So, quick bio.
So, going back to Kevin, we've actually loved having him on board. He's done a great job with us. Brief bio on myself. I actually have a background in legal. I was coming out of school a couple of years ago, and I was working with a title insurance company who really had a great niche with what they were doing. They had a ton of speculation clients who were doing renovation fix and flip projects, as well as development deals. And from a development standpoint and a business development standpoint, they've been facilitating these types of projects long before the term crowdfunding really even existed. So I joined up with them, and we were looking at different ways of growing an organization, and crowdfunding came up as the go-to, since it was something that they were already doing, and we as an organization were already doing. It was kind of the next logical step for us. So we started the process a couple of years ago, went through the strokes with the Securities and Exchange Commission to figure out the regulatory and compliance side of things, and we set up our technology platform, and we launched back in July, and we haven't turned back. It's been a great experience for us so far.
Cool, man. So just before we go on any further, if anybody's tweeting, I don't see many phones out, which is nice to see, I guess. But if anybody's tweeting, our handles are all up here. Crowds Unite. It's at Crowds Unite. Alan at Alan Schanfecker. Mine's at Stogie Munster. Our company's at Share Estates. Eisner Emperor, True Crowd, I think, is one of the other sponsors. And then if you are tweeting, the hashtag tonight's Share Estates Live. So just wanted to get that out there before we go on. So I'm going to start firing questions down and see if I can stump them. Good to see you, buddy. So, Twitter definition of real estate crowdfunding.
So it's kind of evolved a couple of different times over. Real estate crowdfunding is basically the process of connecting people who are looking for capital on their deals, whether it's debt or equity, with investors who are looking to place their capital. It's basically a passive investment vehicle for people who have day jobs, and they have capital that they've saved up and they need to put it to work, but they don't necessarily have the time to go out and vet their own deals and find the right transactions. So we provide a marketplace that connects the two of them, usually providing a cheaper source of capital for the sponsors, the developers and borrowers, and then also providing a passive investment vehicle for investors.
That's the lawyer's answer, because that definitely wasn't a Twitter answer, but good job. And if anybody during this has any questions, just throw something up in the air, and we'll go ahead and get at you. So the concept of real estate crowdfunding, where did it come about? Who was the first player in the space?
So the term crowdfunding is kind of new. It was put into effect via the Jobs Act in 2012. The larger concept of pooling investors together and funding a project has been around for decades. I mean, centuries really. I think the Statue of Liberty was crowdfunded a long time back. But as far as players in the industry, Lending Club was one of the first companies out there. They provided a marketplace for consumer debt, where somebody could go on there, put up a project or a loan request for up to $35,000, and investors would invest as little as $25. Lending Club would package those loans and put them out. That kind of evolved over the years, and real estate crowdfunding came about. I think the earliest companies were up in 2010, Fundrise. They're a real estate crowdfunding company that's based in DC. They've done an awesome job. They've actually done some public offerings as well for non-accredited investors, and since then, the industry's really grown and evolved. I think there's probably 60 plus, maybe 75 plus companies in the space now.
Yeah, continuously growing. It seems like everybody keeps opening up a new platform. There'll be like 3 more tonight. Yeah, that's all. How does real estate crowdfunding compare to REITs, which we were talking tonight about? Neil Shear back there.
So that's actually a pretty common question. There's a few key differences. REITs kind of come in 2 flavors. You've got your public REITs and your private REITs. So one of the differences lies in whether you're dealing with a public REIT or not. Public REITs are traded on the public exchanges. They're subject to some of the volatility there. You get the fluctuations that you would normally get in a stock. There's also a big difference in the transparency of it all. If you really dig, you can find where your money is being put to use in a REIT, but for the most part, it's almost like a blind pool. You're putting your money in, you don't really know where your dollars are being put to work, what types of deals are being put to work in. With crowdfunding, you really get the transparency of it. You get to log on and see the individual investment opportunities, whether you're talking about a triple net lease or a hospitality play with a hotel or even a debt project on a renovation fix and flip in Brooklyn. That's one main difference, and then there's also differences in tax treatments and whatnot, but those can get a little complicated, so I'll table that.
And then there's regulation, right? It's regulated by the SEC. Can you just explain a little bit? You mentioned Regulation A, so why don't you just mention that first, and then we'll get into the accredited investor side.
Sure. So most of the crowdfunding companies that are up right now are focusing on accredited investors. Quote-unquote crowdfunding, like I mentioned before, was put into effect in 2012, but the SEC hasn't finished the rulemaking on it, so the non-accredited investors have a difficult time finding investment opportunities. We at Share Estates and a couple of other companies out there have taken advantage of some of the other loopholes, and they're not really loopholes, but pre-existing regulations in the Securities and Exchange Commission's framework. One of those is called Regulation A, which is kind of similar to doing a full-on filing for an IPO. The Regulation A process is very time-consuming and expensive. It requires us to file pounds and pounds of paperwork and actually wait for a qualification from the SEC before we can solicit and accept funds from non-accredited investors. It makes it a little difficult to work with because most of the developers that we deal with need access to financing relatively quickly. So they don't have the time to really wait. In some cases, it could take 9 months to qualify a deal. We've managed to get that down to about 11 weeks. It's still a little difficult to work with. So for the time being, we are focusing on accredited investors, and most people in the space are focusing on accredited investors until Title III of the Jobs Act is live.
So that's one of the challenges, basically. Like a Reg A can be definitely a big challenge. What are some of the other challenges for the platforms like Share Estates and some of the other platforms that are out there?
So the regulation on a federal level with the Securities and Exchange Commission is one problem. Then you've got the state regulators, which have their own set of rules, and you've always got to make sure you're in compliance with those. Really, once you get outside of that, there's a bunch of factors that kick in. When we're doing debt projects, we're subject to banking laws on a state level and on a federal level. So there's definitely a lot of different moving parts. One of the biggest challenges for us starting off was kind of finding that balance between bringing projects to the platform and finding investors that are looking to partake in that. We've gone on so many meetings, and one of the things that comes up pretty often is that there's always a pendulum swing. Sometimes you've got more deals than investors, and other times you've got more investors than deals. So we really just tried to hone in on that and kind of grow both sides of the business at the same time. But it's always a work in progress.
So there's 2 players generally in this equation. Aside from the platform, there's an investor, and then there's a borrower who is known as the sponsor in the real estate world. Who is an investor? Who fills that role?
An investor could pretty much be anybody that qualifies as an accredited investor. For those of you guys who aren't familiar with that, that's basically, it's defined by the SEC as an individual who has annual earnings above $200,000, or if they're married above $300,000, or a net worth over $1 million, excluding their primary residence. You can imagine, not too many people qualify for it. I think something like less than 3% of the U.S. population actually qualifies as an accredited investor. And then on the sponsor's side, it could be really anyone that's doing from anywhere from a residential fix and flip project to a larger condominium development deal. We've seen all kinds of different projects.
Right on. So I've heard the term crowdfunding. Obviously, this is a real estate crowdfunding talk, but I've also heard crowdfinancing. I've heard, at least on the lending club side of things, like consumer debt, small business debt, you're getting marketplace lending and investing. What do you guys call it? And whatever you call it, I think that's what should be called from now on. So.
I like to stick to the marketplace lending and investing, and the reason for that is mainly behind the different types of companies and individual investors that we're marrying. One of the things that we've noticed is that individual investors like to invest side by side with larger, more experienced investors. Sometimes that might be an institutional investor or family office. And we're not specifically limiting our projects to one or the other. So as an investor on our platform, and this varies from platform to platform, you can actually come on and invest in a deal alongside of a $5 billion fund who has actually put capital into the same deal. And it gives people kind of a sense of, peace of mind, or whatever you want to call it, that they're investing side by side with somebody who's experienced in the space.
Right on. So walk me through the experience, like on the share estate side, the process of actually getting a sponsor, matching them up with investors, fully funding a deal. Just walk me through that experience as if I've never heard of this at all.
Sure. So the experience for us is probably a little different than it is for most platforms, because our background was actually in title insurance, and we were dealing with these investments long before crowdfunding and share estates existed. We have access to quite a large amount of deal flow in this space. So one of the things you'll notice with some of the platforms out there is that they're tech guys or finance guys trying to get into the real estate space, where our core is that we're real estate guys and we're trying to bring that investment to more and more people. So for us, most of our deals at this point are coming through our relationship with our title insurance company. They have deals being submitted to them for general searches long before banks get involved for financing or investors get involved. So we get a first look at those projects, and we know from that track record who the investors are that are going to be looking, who the sponsors are that are going to be looking for different sources of financing. So we'll hone in on a deal, we'll cherry pick the deal. We run a curated platform, so we're going to basically be vetting the project, vetting the sponsor, checking their track record and everything else. We look at overall 32 different variables in vetting that project, and assuming we get past the initial screening, at that point we have our standard agreements that we go through the sponsor with that basically disclose what the fundraising process is like for us. We get them up on the platform, we market we market the deal, and we try and get our user base involved as much as possible.
And then once you do, let's say you do fund a deal,
Sure.
What's the process after it's funded? There's reporting, and
Right.
what else is going on?
So it varies for different deals. When we're dealing with debt investments, we generally have monthly distributions to the investors. So as our borrowers make payments to us, we make payments to our investors. So they'll receive a monthly distribution. They'll receive reporting in the form of pictures and videos on development deals, so that they can gauge and track the progress of let's say a condo development project. They'll get financial reports and tax documentation, so they can see where the money is being spent, how it's being spent. In some instances, we do have on our development deals the opportunity for different investors to actually be a part of the development, in the sense that we'll give them the opportunity to, let's say, vote on what type of tile is used, or what type of brick, or et cetera. So it gives people some actual interactive involvement too. Not everybody gets involved in it, but it does come up from time to time.
And if the deal doesn't fund?
One of two things. So we usually have a funding amount, a target, set at the onset of our capital raise. It varies from deal to deal, but usually there's one of two things that's going to happen. If we don't hit our target, the funds are returned to the investors 100% without any deductions of any kind. Or if there's a contingency plan in place, that might go into effect. And that contingency plan can vary from deal to deal, but sometimes it'll be the sponsor allocating the remaining funds, or potentially bringing in backup financing or a bridge loan of some kind to extend our capital raise time frame.
What happens if the terms change?
Usually, to date, we haven't had any terms change. Any backup financing that we've had in place is coming on the same terms, so our investors have been in the same position as day one. But if there were to ever be a change in terms, our investors would be given the option of either staying in the deal with if they would like to take their capital out, let's take their capital out.
And then other risks that are involved. Let's start with the sponsor. What are some sponsor risks involved in real estate crowdfunding?
So there's really a few risks you're taking when you invest through crowdfunding. One is the risk of the actual underlying deal, the market it's located and whatnot. The other is the risk you're taking with the project sponsor. How much experience do they have? How many millions of dollars of similar projects have they developed in similar markets? And then the third risk is it's actually a credit risk with the platform. One of the questions we actually get asked pretty often is what happens if Share Estates goes out of business and the underlying asset or real estate investment is still performing. We try to alleviate that issue with a special purpose entity, or what some people call it a bankruptcy remote structure. So we set up each one of our deals in their own vehicle, and we have a backup servicer in place in case something were to happen to Share Estates that would basically step in and continue servicing that investment, that project for our investors. The risks associated with a sponsor can largely be alleviated with a track record, right? So that's one of the major things that we look at when we're looking at our projects is what's the developer's experience in the market? What's his experience with that property type? Are we talking about a multifamily, an office building, mixed-use property? What's their experience in that development phase? Has he done the renovation fix and flip before? Has he done ground-up development before, or is he primarily dealing with rent-stabilized properties that are cash flowing? And outside of that, I mean, what's their track record for millions of dollars developed, and what markets have they worked in? Are they similar to where the proposed project is? So aside from running credit checks and everything else to make sure everybody is on the same page and in good standing, the track record is very important in vetting those projects.
And what kind of returns are your investors seeing in some of your projects?
Those again, everything varies. The debt deals are a little easier to categorize because they're fixed income assets. Our sponsors are usually taking the loans anywhere from 11 to 14% annualized interest with up to 3 points in origination. Our fee model is based on basically collecting the points up front for structuring the deal, and then we take a servicing fee to the investors up to 2%. So on a deal that goes out, let's say at, I'll tell you what we've been doing. Most of our deals have been going out at the 12% ballpark. So if we take a 2% servicing fee on that, our investors are seeing 10% annualized interest. We have had loans go out in the 11% range. And where that does happen, we like to always keep our investors up above at 10% or higher, so we shave off our servicing fee to compensate. And then on the development stuff, you're usually looking at higher returns, but again, there's increased risk because you're talking about a ground-up project, and you're not seeing cash flow during the interim of that project. So we recently actually funded a small piece of...
Don't skip ahead.
Okay. I guess that one's coming up.
I actually want to know what some examples of debt deals look like. Give us some examples of a debt deal. And let's take a step back. Let's go through the capital stack, right? The capital stack with financing a real estate project, starting from your senior debt and go down. Okay. Just describe what it looks like.
So that's one of the categories we look at on our underwriting process is where are we in the capital stack? You can have a simple deal that's just a cash deal. You've got one source of financing in that deal, or you could have a very complicated deal that has 7 or 8 or 9 or 10 different sources of capital. So when we're looking at the capital stack, you'll have sometimes senior financing in place, which is going to be your traditional bank financing. If we're talking about a development deal, that'll come in the form of a construction loan. Sometimes you can have what's called mezzanine debt, which is a second or a third lien that's placed against the property. Anytime you're talking about debt financing, generally there is some sort of lien placed against the property so that the property is taken as collateral. But again, as you move down those lien positions, your risk increases proportionally because there is going to be somebody in a priority position to you. And then you get into the preferred equity, which is like mezzanine equity, preferred equity, they're kind of used interchangeably. Once you're in the equity scene, you're either the last or second to last person to receive your capital back from a project. So in the pecking order, you've got your senior debt and then your mezzanine debt, and then your preferred equity, which is going to be superior and ahead the common equity investors, and then you've got your common equity investors who are usually going to be our project sponsors they're generally, the way we structure our deals, they're the last person to get their capital back out of a project, and also the last person to get their profits on a project. But on the flip side of that, they actually potentially have a higher reward for being in that increased risk position.
Right, right. So back to, what does an equity deal look like now?
Sure. So there's so many different ways to skin the cat. What I was going to do before was basically give you an example of one of our most recent deals, which was a condo development deal in the East Village. We were approached by a sponsor who was doing a 12-unit luxury condo development project. It was a $24 million project. He had $16 million in construction financing in place already with the bank. He needed to come up with an $8 million capital stack for the equity. And when he actually approached us, we were still kind of in the process of launching, so we weren't comfortable taking on the full commitment. So that sponsor went out and raised his capital through his usual sources, and he came back to us when he had roughly a $600,000 clip open. And we joined him on that capital raise. That was a common equity project. We raised those funds in, I think it was 18 hours. And investors on that deal are looking at I think an 88% return over 26 to 36 months. So it works out to, roughly a 30% annualized return. Again, it's always a projection, but the East Village in Manhattan is usually a safer bet than some of the other markets that you see deals going on.
Right, right. And has Sheriff States had any defaults?
No, so everything. Thank you. Everything that we've had so far has been performing. Prior to our launch, by we, I mean my partners at the title insurance company, and I placed about $25 million in comparable investments across debt and equity deals. It was roughly about 40 projects. Never had a default, never had a loss of any kind. So far, since we've launched the platform, we've done about $3.5 million in placements, but it was mostly in the last three months or so. And everything is cash flowing. The debt deals are all cash flowing to this point. We haven't had any defaults, and the equity projects are still actually in play. So we're not going to know where those end up probably for at least another 18 months or so, but they're looking good.
Does anybody have any questions thus far? Yeah.
Can you kind of describe the difference between a traditional private equity firm and this, and are you seeing a lot of that, people that are using that model, they're doing developments, and they're raising money from friends or family, saying, hey, we can grow, and this can help us automate, is that what you're seeing? Is like a lot of professionals with that are used to that model coming to this?
Yeah, so we see it on both sides. So sometimes we have developers who use friends and family capital, and they're kind of already crowdfunding for themselves, and they're just looking for the software or platform to facilitate that process for them, maybe bring in some new investors, but also to capitalize on their existing investors. And that's kind of where we come in with reporting and everything else, and kind of using that process and taking the burden off of the developer so that they could focus on what they do best, which is developing. And then we have other guys who go to private equity or have gone to private equity in the past, and a lot of times what happens with those firms is that they take a lion's share of the deal, right? Because they're in a position where they're like, okay, we're going to fund 100% of your capital stack, they get very aggressive with the deal, which, in my opinion, doesn't leave as much of an incentive for the sponsor to do a great job, because he's kind of being ousted from the project. So what we do is we generally structure the deals to be a little fairer. There's still great deals for the investors, of course, and the sponsor, it's a win-win. Sponsor's happy, they have a slightly cheaper source of capital.
How much information do you provide the investors before they invest for due diligence?
Sure.
So what's the package like?
So we actually just launched our 2.0 version of the platform, which is totally transparent. We disclose our complete underwriting process, the 32 variables that we're looking at.
So what are the 32 variables, and what does the investor get?
Sure. So on a macro level, some of the things we look at are the LTV of the property, the lien position on the property, or if we're talking about equity.
Does the investor get the underlying information to understand? Because let me be honest, I work with a bank, and I've had 25 years real estate experience in credit.
Okay.
So, and I've done workouts for about 150 billion. So I just want to understand what package, if I go and look on the website, what financial information am I going to get from you?
Sure. So we're making redacted credit reports available. We're making purchase contracts available, title insurance searches available. We have the underlying agreements between us and the sponsor available, as well as our underlying agreements between us and the investors. If there's comps or BPO, for example, a broker's price opinion, that's made available. Pretty much anything that we have access to from the vetting standpoint is made available.
Will I have any of the original financial statements?
As far from the sponsor?
Yeah.
Yeah, you'll have access to a project budget, capital balances, everything. Anything that's potentially made available.
What about the senior debt? Will I have access to the terms and transactions?
You'll have access to the terms and transactions of that as well. So, for example, our deal that we just did, or that we're in the process of doing in East Village, we disclosed who the loan was with. It was with, I can never pronounce it, Natixis? Yeah, that's it, sorry. We make the terms of the loan available on a totally transparent.
Will I have that actual document?
You'll have the LOI. So, in other words, when we're getting involved in a deal where there's bank financing, the bank financing is usually going to be locked in until the equity capital is raised. So we'll have an LOI and basically like a binding term sheet available, and then once the equity is raised and that deal goes to the closing table, and that loan is finalized, you as an investor will have access to the full terms from A to Z.
What about the deal documents for the mezzanine funding or things like that? Who has control over those?
As far as
Will I see the final document?
Of course, the investors are actually invested in the deal do.
Okay, if a deal defaults, and let's say, for example, you have you have a $1 million deal with 200 investors with $5 million, and now you have to work out that transaction. How will that be done?
I'm not sure I understand the question.
So, for example, when you have, the deal's defaulted, and now you're somewhere in the debt stack. Let's just pretend you're in the mezzanine.
Okay.
And usually the mezzanine has a right to buy the senior.
Okay.
But you're participating with 2,000 other investors over the rights to whether you're going to do that or not.
So
who has control?
Our structure is set up with what we call borrower payments or project payment dependent notes. So, in other words, what we do is we issue unsecured notes to our investors in series that are then tied to the performance of a specific project. So, on the books and records, assuming we have more than one investor for a particular deal, Share Estates is the secured party against the collateral. Share Estates is the servicer and would pursue that deal through foreclosure or whatever the form of recourse is.
Agent.
Basically, and then whatever we recover would then be prorated back to the investors.
Okay.
What's your due diligence process for the qualified investors? Do you guys perform, or is it something?
Sure. So this kind of stems back to the securities regulations. Right now, we're currently dealing with accredited investors. September of 2014, the securities landscape kind of changed. So back in the day, basically declaring whether or not you were an accredited investor was as simple as checking a box when you're registering for whatever it might be, a fund or platform. But there were certain restrictions in place. That company couldn't publicly advertise and solicit. That's on a technical level called the 506B offering. In September, part of the Jobs Act went into play, which added Section C of that, which is a 506C offering, and that now lets people publicly advertise and solicit for their deals and their funds. But as an added burden for doing that, you have to actually go out and verify accreditation. So there are actually independent parties now, companies that have come up to do that for you. We do everything in-house. There's a couple of different ways of verifying it. Sometimes it's taking the person's tax returns or having a form filled out by the investor's attorney or accountant. There's a few different ways of verifying it, but if we are talking about a publicly solicited and publicly advertised project, yes, we do have to verify accreditation.
You guys are doing all that work.
What was that?
You're doing all that work.
Yeah.
For the people that want to do it.
Yeah. So the majority of our deals today have actually been 506B offerings. We advertise the platform, but no specific deals. So when somebody comes to the platform, there's a cool down period from when they register until when they're actually permitted to invest. And because we've been doing that, we actually haven't had the obligation of going out and verifying accreditation, but we're slowly making the shift to 506C offerings. And as we do that, we'll have to actually verify.
I have a couple more questions. Are you taking capital up front, or are you doing capital calls during the project?
It depends on the project. So everything to date has actually been funded up front. But for example, we're doing a project right now, which is, it's actually a 506C offering, so I could tell you about it. We're building by we, I mean we're partnering with a developer, Rockwell Developers, to build a 7,500 square foot luxury home on the Gold Coast of Long Island in Great Neck. That particular deal actually doesn't have any debt on the books, so we're actually raising the whole capital stack as equity. We're in there for 90% of the capital stack. Total development on it is about $3.167 million. Because we don't need all the capital up front, we're actually raising it in 3 different phases. So we've got our first phase going up right now, which is raised for $1,575,000. And then 3 months from then, we start the second phase, which we're going to be raising about $650,000 for. And then the third phase kicks in 6 months after that for another $625,000. And we structured it that way for a couple of reasons. One is because we don't have debt on the books, we're trying to maximize the returns of the first phase investors. And also, Rockwell has a great track record. Actually, about 9 to 10 months into their development, they usually have an end buyer for their projects. So our investors that are going to be coming in on the third phase already know that there's an exit strategy, there's a buyer in mind, and we can justify structuring the deal with a lower return for them than we would have otherwise been able to do.
Sorry, just 2 more questions.
Sure.
So you're putting the money that you raised in a segregated account, and you're doing it much like a construction loan, as the construction companies submitting invoices and need more money?
Yeah, so we've got a couple of different structures that we deal with. Everything is funded through an FDIC-insured escrow account on the platform. When we do the equity projects, we're usually in a management position on the project as well, so the bank account for the entity is actually with our bank at Bank of America and our bankers. We have full access to the account. We have co-signing privileges with the project sponsors for withdrawals over, for example, $20,000. So we can actually track the progress as it's going. When we're talking about a debt investment, we usually, if we're talking about a purchase, we're funding a portion of it at the table, and then in some instances we might have draws for the rehab. And at that point we would have to go in and do a visual inspection before releasing funds.
What are the typical qualifications for people who are doing the due diligence vetting in your shop? Because quite frankly, as I mentioned, I'm a real estate attorney. I've worked with many title people who don't necessarily have those kind of qualifications.
Right.
So I'm really wondering who's actually looking at the documents and making sure everything is
Right.
needs to be.
So we have about 10 people on our team overall. My partners on the title insurance side, before they actually were in title insurance, were real estate speculators themselves. So they've done the renovation fix and flips, they've done the development deals, etc. When the landscape kind of shifted for them, they got into the title insurance world. They've been there for about 10 years now under Atlantis National Services. They're operating in 33 states, and they're processing somewhere around 300 files a month. But a core group of their clientele are actually returning investors, and they've invested side by side with those investors. So there is a track record for my partners vetting these types of deals as far as verifying proof of funds, verifying the budgets involved with the projects, etc. It is largely a product of their experience. I come in more on the legal side of things and for deal structuring purposes. But they also, with Atlantis, run a 30-person operation where there's accountants and attorneys and everybody else involved. So there are multiple eyes on the projects as far as the vetting is concerned. And as we grow, we're probably going to bring in somebody as a full-time underwriter strictly to focus on that aspect of the business. Anybody else?
I'll continue the multiple question trend. My first question is, as far as how much equity has been raised today across all the platforms?
The real estate platforms?
Right, the real estate platforms.
I honestly couldn't tell you because there's so many of them out there. There's, I think the most recent published work was what Huffington Post said there was over 75 platforms in the space. So I don't know how much they've each raised. I can tell you some of the bigger players in the space are in the between the $30 and $50 million mark as far as capital placed. So I'd say overall there's probably
A few hundred million.
there's got to be at least a few hundred million that's been raised to do such platforms.
And once the rules are actually, SEC makes the final rules on the non-accredited investors, do you guys anticipate an explosion in the amount of equity that's going to come into?
So it's funny, when we first started this platform, we actually were really interested in focusing on the non-accredited investor, which is why we went through the strokes with the SEC on the Regulation A projects. We realized it wasn't workable. Once crowdfunding goes into effect, it's kind of hard to say what's going to happen because the final rules aren't in place right now, but some of the states have been proactively putting out their rules. So you got to always remember it's not just the Securities and Exchange Commission, but you got to be in compliance with the state rules as well. And a lot of the states are actually placing limitations on who the issuing company is and where they're actually formed. So for example, one state, like let's just take New York for example, their rules aren't finalized yet either, but they might say that, okay, in order to raise capital from New York residents, non-accredited investors, you would have to actually be a New York formed entity. So by virtue, you can't necessarily crowdfund from the entire country. So I don't know how it's going to play out. We just got to see what the final rules look like. But I think it'll definitely be helpful.
Any other questions from anybody? Yeah.
Are there instances where you're approached by someone who has a piece of land that may be of interest to you, and you can help bring in the other partners to take a project to completion, development project?
Yeah, so going back to what I mentioned at the beginning is a lot of the platforms out there right now are tech and finance guys, and they're kind of scrambling to find quality deals, whereas because of the clientele that we deal with on the title side of things, we actually have the different parties in place, and we have made a business out of connecting those people. So yeah, I mean, for example, we recently connected somebody who does foundations with a developer friend of ours. It wasn't a deal that we did through share estates, but they were both clients at Atlantis. The developer was looking for a cheaper and a new guy to basically replace his old foundation wall guy. And we connected the two of them, and they've been working with each other ever since. So we definitely connect those guys, yeah. Anybody else?
I have a question.
Sure.
I'm a real estate broker, and I'm wondering what you foresee as far as just the traditional brokerage community, the acquisition and disposition of properties. What do we need to know about what you're doing, and how do we facilitate it in a way that it seems to make so much sense, for clients that they're deciding on, instead of buying, they'd like to get involved with this instead. Instead of being a direct investor, maybe this makes more sense. And are there any things we need to know?
Yeah, so as a real estate broker, you have to separate being a real estate broker with selling kind of these crowdfunded investments, because at the end of the day, our investments are securities, completely different licensing. So you, as a real estate broker, maybe saying to a guy, hey, like, why waste your energy trying to do this project when you're a doctor? Maybe you'd rather just do a passive investment. In order for you to be compensated for that, you would actually need to have your securities licenses.
Right, so if I have my Series 7 or something of that nature, and I'm affiliated with a dealer.
Right. Then yes, yeah, you could definitely take that route instead of...
Do you foresee investment consultants and advisors that are licensed for securities getting involved with this? Are all of you guys licensed, or do you need to be based on the new regulations? Or
so securities law is a little bit complicated. There are a couple of different factors that the SEC and FINRA will look at when determining whether somebody needs to be a licensed broker-dealer or whatnot. One of the major factors in that is whether there's transaction-based compensation. Our team doesn't actually take any transaction-based compensation. It's all at the company level. So we don't have, I'll get into that section of it, but to date we haven't actually had a sales team that would go out and strictly work on a commission basis. Everybody is a salaried employee. We are actually now looking at partnering with a broker-dealer to take advantage of their registered representatives and their sales teams to really expand the platform, because at the end of the day, there are, like you said, wealth advisors and whatnot out there that have access to this type of investor base, and they're looking for different types of asset classes to invest in, and sometimes the yields aren't there, but there definitely are with the real estate crowdfunding side of things. But yeah, to answer your question, yes, I definitely think there's room for growth there.
Yeah, so I came from that side, and now in real estate. I was a CFP for 18 years, and had it been around, I would say it's part of your allocation. You need to think about it, but it couldn't justify someone taking $1 million and plunking it into something, or they could buy a REIT, whatever. So this is a little bit more exciting for some people that want to be very close to.
Yeah, it's kind of that hybrid model where maybe you want to be a direct owner, but don't necessarily want the headache of getting that phone call at 3 o'clock in the morning about a toilet breaking or something. So you still get the transparency of direct ownership. You still get the financials and everything else that go with it, but you don't have any of the headaches, and you get to diversify also. So you're not putting all your eggs in one basket. You can put 50,000 here and 10,000 there, so on and so forth.
Are there any other real estate brokers out here? Yeah. And then who else is out there? Attorneys, banking, finance side? Anybody? What do you guys do?
I'm an astrologer.
You're an astrologer? Tell us, do a little fortune telling.
Professional poker player.
So go ahead.
Do you guys ever do partnering with funds that are putting together, off-campus housing funds that buy off-campus housing in the southeast, southwest?
Right.
So crowdfunding to put together in their, fund to buy properties.
It's doable. We haven't done any of that to date, just because most of the investment appetite that we've had have actually been for the fix and flip style projects. We actually had somebody approach us about doing, basically privatizing student housing in Florida for, I think it was, I want to say West Palm Beach, I might be wrong. We decided not to go ahead with the deal for a few reasons, but it's something that we're of the mindset that if the deal makes sense, we're going to do it. We haven't kind of pushed ourselves into a little niche category where we're only doing debt or only development or only value-add fix and flip projects. So really, no matter what the deal is, as long as the metrics and the financials of the deal make sense, and we can wrap our heads around it, it's something that we would explore.
This is a longer time horizon, 5 to 8 years, 13, 14% annual returns to their investments, things like that.
It's definitely something doable. So one of the things we've noticed since we started is that the longer duration projects are a little more difficult to sell. This is me speculating, but I think part of the issue is that we're dealing with such a new industry, and there's still quite a bit of credibility that needs to be built around it. And I think people getting in and out of deals and seeing the cash flow and seeing the distributions and getting their principal back is going to help us get to that point.
Okay.
But right now, people, they want to get in and out of a deal so that they know that this works, and it's not some sort of a pyramid scheme or something. There's a lot of hesitation around it. We're asking people to go online, look at a company that doesn't maybe necessarily have such a large track record or such a large operating history, and we're asking them to trust their money with us. So I think it's something that over time will definitely grow and be a little more doable, especially when you start plugging in some household names, for example, on the development side of things. But it's going to be a work in progress for a long time.
So it's not something you guys are doing?
Not right now, no.
You guys mentioned liquidity, so if it's a long-term project and someone wants to get out, can he sell his ownership to somebody else, or do you have a marketplace?
Sure. So one of the things to note about these private placements for the accredited investors is that twofold. One is they are restricted securities, so they can only be resold to other accredited investors, and there's also no marketplace for them. So you can't just log on to an exchange and sell. It is something that we're exploring, actually. We would like to build a secondary marketplace for our platform and as a software for other platforms. There's a ton of regulation around it. you got to have a broker-dealer's license, you got to register as what they call an alternative trade system. And it's a long process, but I think as the number of offerings on our platform grows and as the user base grows, it's definitely something that we want to offer. But right now, it's not available.
I have noticed on a couple other sites that the crowdfunding sites will actually put their own money in and then divvy out to their investors. That's not something you're doing. Is that something, well, at least I can't tell, is that something you would do in the future to make the point that you feel that investment is, the first quality?
So there's a couple of things going on there. So you've got some companies that pre-fund the deal and then crowdfund it out. And you kind of got to look at where that source of capital is coming from. So some of those groups are actually, they did a capital raise for the company, and they're putting, it's their own company money, but it's not really, right? They kind of made themselves into a fund. With our projects, we've actually been investing in the deals. We don't mark them as we've invested, just because we don't want to steer people to one project or another. It's something that is also going to be difficult to scale with. So while we're a newer company and the number of transactions we're doing are on the smaller side, we've actually been investing in them. Not from the company, but from the actual principals that are involved with the company. As we scale up and as we start doing 30, 40, 50 deals a month, it's not going to be scalable for us to do that necessarily, which is why we're not advertising that we are, because we don't want to say that we are and then turn around and say we're not.
The East Village project you mentioned, what was the incentive for that sponsor to go out and raise 10% of the money from your platform versus going to the 90% of these investors and just asking them to pitch in a little more?
So he did go to his other investors actually, and he raised most of his capital stack from them, but he had a structure in place already. He had a certain number of shares going at a certain price, and we committed to being able to raise that clip for him. So rather than changing the entire structure and having to reapproach investors that he already gave terms to, this was just an easy alternative that didn't hurt anyone. So that was plus we say as investors you never want to have all your eggs in one basket. As a sponsor, you never want to have all of your sources of capital in one place either. So the more you can diversify and the more avenues you can open yourself up to fund your deals, the better off you are. This kind of goes unnoticed a lot of the time, but there is a social capital that kind of comes along with crowdfunding, and that is the more people you have involved in your deal, the more people you have selling and marketing your deal, because the more they can drive it, the higher their returns. And where it comes to things like, let's take a zoning issue, for example. Maybe there's a deal that we're doing that's dependent on the zoning approval of some kind. If you have 300 investors calling your local zoning board and trying to push something through, it's going to make a much larger impact than having one guy call and try and do that. So there's definitely some hidden treasures that some people don't realize up front.
That's happened before too.
Yeah, it's happened. Not with us, but it's happened with other platforms.
In terms of depth of liquidity you provide to sponsors, let's say you were funding the full $8 million on the East Village project. How many investors would you think would subscribe to this offering, and would they be first-time investors with the sponsor, or this is more repeat business done through your platform?
It varies. We have people that invest as little as $1,000, and people that invest as much as I think 250 has been the largest contribution, 250,000 from any single investor. We do have a set of investors who are repeat investors on each deal. We have other investors who are kind of testing the waters and they want to see how the first cycle of investments goes before they throw more money at it. Not that they don't have it, but again, it's a new sector, it's a new industry. We're a new platform in that new industry, so it's a trust and credibility thing. It's just, I think it'll increase over time.
Do you have the ability to take foreign money, numbers and mailings located outside the U.S.?
So as of right now, we're actually only taking U.S. residents. We have explored foreign capital. There are ways of going about it. It's a little easier to do on the debt projects because there are certain exemptions in place that allow us to take that capital without necessarily withholding on the tax side of things. It's much more complicated with equity actually, because depending on the structure of the investment, there's going to be potentially 40% withholding on that person's returns, and it's a little more difficult to sell when you've got those problems in place. But you know, there's always different tax structures that get around that issue, and it's something that we'll probably explore down the line.
How are you guys sourcing the deal flow and attracting new investors?
So deal flow really goes back to our title side of the business. So there's approximately 300 files coming through on a monthly basis. Roughly 150 of those close, and anywhere from 30 to 50% of those files are actually speculators looking for financing, either on the debt or the equity side. So we have first look at it. They're clients that have been long-standing clients of Atlantis. It basically allows us to transition those people from their current sources of financing to share estates as their new source of financing on similar or better terms than they're receiving. For the investors, it's really been word of mouth so far. We've done some minor marketing. We've had some press and media attention. We've had articles in Business Insider, for example, and The Real Deal. So we haven't jumped heavy into marketing quite yet. We're kind of waiting to see how things play out with some of the other platforms, and also to build our track record up a little bit more, so that when that traffic does come to the platform, they can see, you know, a track record of performing projects and, you know, make some testimonials from our existing investors.
What percentage of the project that apply to the platform get rejected?
At this point, we're probably only taking about 2% of the deals that we're reviewing. We have the ability to take more of them, but so we launched in July, and part of our launch with our Regulation A public project was really listening to our community and trying to get as much feedback from the user base as possible. So our first 4 months out of the gate was actually very slow. We focused on one deal. We tried to collect as much feedback from our users as possible. We took that feedback and we actually used it to redesign and revamp our platform, had a ton of bells and whistles. So we just actually launched our 2.0 version of the platform 2 weeks ago? About 2 weeks ago. That being said, we're gearing up to start putting out more deals, but we're not going to compromise our underwriting guidelines to do it. So I'd say about 2% of the deals that we look at actually get onto the platform right now. It's probably less than that, actually. And as we grow our investor base and as we bring on some of the institutional investors, we'll probably start putting out more and more deals. But again, always maintaining our underwriting guidelines.
Who are your main competitors, and how do you stack up against them, especially in terms of, you know, what's your competitive advantage? What makes you unique, apart from the real estate, being from a real estate background?
Okay. So some of the more popular names out there right now are companies like Realty Mobile, Fundrise. There's Patch of Land, who's actually done a tremendous job. They're focusing solely on debt. A lot of these different companies are kind of picking a niche to focus on. One of our biggest competitive advantages is having access to these quality deals. We've actually done a side-by-side analysis of our projects, you know, across some of the other platforms for our own internal purposes. We haven't released that information, but we're confident that our deals are of a higher quality and standard than what you're seeing on some of the other platforms. And also part of the reason why we're going a little slower with things is to kind of see how the market plays out on some of these other platforms. I think that there are a lot of players in the field, and I think that not coming from a real estate background, some of them might be putting up some projects that we wouldn't necessarily post. And I think long term, you know, there's going to be some fallout, some losses, and those losses are really what are going to make the premier and quality platforms rise above the rest. Anybody else?
Any skeptics out there? I'd love to hear your thoughts. I mean, I like getting the feedback. We like getting that feedback.
So we're trying to throw me under the bus.
You have to challenge the guy, you know.
I like anything disruptive, so I think this is great. It can only get better.
Yeah, so just kind of like from a macro view, our backgrounds, myself and my two partners from the title side of things, we all grew up on the other side of the tracks. We come from immigrant families. We didn't come here with very much, and we kind of felt that struggle growing up as far as what we were going to do. We put ourselves through school. I'm sorry, and we've really worked pretty damn hard to get where we are. So we love this concept because it gives people access to something that they may have not, otherwise not had access to. And hopefully, you know, when Title III of the Jobs Act goes into play, it'll let us expand, you know, our purview and our audience. Sure.
You mentioned that the company hasn't really is still sort of figuring things out. In light of what's going on with the housing market, you know, affordability being a sort of big push for the mayor, do you see yourself sort of looking at affordable housing deals?
Yeah, so I think this kind of goes back to one of the questions you had earlier is we'll look at any project as long as the financials make sense. At the end of the day, there's a threshold of, you know, a return or a projected return that we need to hit for our projects to make sense. And if you visit our site, you'll actually see what our underwriting process is flat out, and also how we rate our projects and what our baseline interest rates are and projected returns are on an annualized basis. We would look at, of course, you know, affordable housing deals if the targeted returns are where we need them to be to incentivize our investors to get involved. But at the end of the day, you can't have one without the other. So if we're talking about affordable housing and our investors are making maybe 4 or 5% on their money, it might not be as appealing to them. So it makes it a little bit more difficult to raise for.
And I think we'll start seeing more, like Alan was mentioning, that there's a bunch of these other platforms are focusing on different niche areas of real estate. I think one of the ones that we haven't seen yet that I think will come about is going to be more of the goodwill product. So something like the affordable housing that might only return 2 or 3%, but people feel good about the investment, and it's a rewarding investment in another way, a non-financial reward. You're seeing this happen on the consumer debt side. There's a company called SoFi, SOFI, and they're refinancing student debt. Because after student debt hits its whatever end of term of 6%, whatever it is, I don't know the numbers, but it then jumps up to like 9 or 11%. And you're talking about someone who just came out of school paying a ridiculous interest rate on their. So SoFi comes in, does a refi on that, and companies love that. Of course, they're investing in something it's unsecured debt, but they feel that it's secure as a young professional that they're investing in. But it's also, there's a goodwill piece of that as well. And I think we will see that on the real estate side.
Sorry. But,
thank you for mentioning this other gentleman that mentioned who do you think your competitors are. But I just wanted to ask your opinion. What do you think of a local maybe competitor or not Prodigy Network?
So Prodigy Network is, they're kind of focusing on a completely different aspect than we are. They were one of the first players in the space. They started in Colombia. They're doing larger scale development deals, much longer term projects than what we're looking at. And I think their minimum investment is actually significantly higher than ours. I think it's 100, what was it?
10,000.
Oh, so they've actually decreased it. I think it used to be 100,000. They're doing a completely different type of project than we are. I don't think they have offered any debt products. I could be wrong. And I think their primary focus is development in Manhattan. So I can't tell you how they stack up to us necessarily, just because we're offering completely different types of projects. But they've done a tremendous job, and they've been in the press and the media, and from what I can tell, they're doing a great job.
In terms of regulatory fees, putting together a PPM, what does that add to somebody trying to raise a fairly small amount of money? Whereas a guy who's raising $500,000 would just make a couple of phone calls, have a one-sheet piece of paper, and say, hey, you want to do this deal with me? If you were to go with your platform, what are the costs associated with all the regulatory?
So that's kind of where we come in. We actually take that burden on ourselves. We've set up our structures so that we act as the issuer. We have our PPMs and our subscription agreements. We raise capital for our entity, and then we place that capital into the sponsor's entity. So as far as the sponsor's concerned, they're dealing with one investor, and it's a standard experience for them as far as dealing with any other single investor. They're not dealing with the PPMs or the legal or the headache or anything else associated with it. We handle that all on our end. That was actually part of our startup process and part of the research that went in and speaking with the Securities and Exchange Commission and the New York Attorney General's office was figuring out what those documents needed to look like. A lot of time went into them. I mean, if you stack them all up on top of each other, there's probably like 120 pages worth of paperwork per project. but it's gotten to the point where it's a pretty standard set of documents, and we're always revising it and adding to it and making it stronger. But it's not something that the sponsors need to be concerned with.
If somebody wants to start investing on share estates, what do they need to do?
They need to visit our website, www.shareestates.com, and just make an account. It takes 30 seconds. You guys can see what the whole spiel looks like, what the investments look like. And I personally work 24 hours a day, 7 days a week. So if you just give us a call, you'll most likely be speaking to either Kevin or myself.
You have to be an accredited investor.
Yeah, so you can still register as a non-accredited investor. We are growing that portion of the user base so that if and when Title III of the Jobs Act does get put into place, we can hopefully capitalize on it if it's something that's workable. And if the right deal comes along between now and then that's serves to be a public project, we would actually consider doing the Regulation A step again too.
You deal mostly with commercial space, or do you do residential as well?
We do both. Most of our deals have actually, it's been a mishmash. We do a lot of 1 to 4 family residential fix and flips on the debt side. Once we get into the preferred equity and common equity side, we're looking at development deals. They could be like for our current deal, which is a single family, extreme luxury home, or it could be for a multi-family apartment building or condo development building. For example, we're doing an 8-unit development project in Long Beach. We're doing the 12 units in the East Village, so on and so forth. It's some mixed-use stuff as well.
So if somebody's buying a house for like $500,000, is that something like a platform, would that be too low for you?
No, it's not too low. We don't do any owner-occupied financing, so that's one thing right off the bat. We do finance, single-family renovation fix and flips. We actually just funded a $512,000 loan for a 2-family home in Queens. It's going to be a renovation fix and flip project. They went in on a higher price point, and they're not putting much money into the deal, but the guy got it at a discount. So it's something that we do facilitate.
Do you guys have an ETA or know about an ETA on the Title III?
I have no idea. This stuff was supposed to be put into place well over a year ago.
Send a letter to your local representative.
Yeah.
There's a strong lobby from the banking system. They don't want it. I've sat down with a few bankers.
Really?
And they kind of like pretend this is a
they look at it as a threat. It's funny. Kevin mentioned Lending Club earlier. When they came into the consumer debt space, the tone was kind of like, oh, we're going to replace traditional financing. We're going to replace banks. It's turned into, oh, we're going to embrace banks and we're going to be, a different type of financing side by side with them. I don't think it's necessary for them to view it as a threat because the banks are focused on debt, right? And Title III of the Jobs Act is really focusing on equity placements. So, if anything, I think it's going to facilitate their lending on those deals. We're talking about having a larger access to equity capital for different deals, and some deals that might not even necessarily qualify for bank financing for one reason or another. So I think they complement each other. I don't know what the fear is, but I've heard that before.
Do you guys have a geographical focus?
New York. Yeah, New York's our backyard. We operate in, the title side of things operates in 33 states. I'm actually their title producer, so I hold 28 of the licenses in those 33 states. But we know New York like the back of our hands, so we're focusing here, and our access to deal flow here is tremendous, so there's just no reason to cut outside of it yet. Anybody else?
Maybe we can move it to a little networking session. Guys, thank you so much. This was awesome.
Thank you, everybody.
Thank you.
Great questions. Crowdfunding, awesome. Eyes are never awesome. Thank you again.
Thank you.